Welcome to the Cashflow Academy podcast. Today we're going to talk about Snowflake, stock symbol SNOW, Snow, and we're going to talk about opportunity, what that company does, analyzing it from a charting, a technical perspective, a fundamental perspective. We're going to do all that, but remember, hit that subscribe button so that you can learn a little bit more about the financial markets and get involved in the opportunities that are out there. So Snowflake is interesting. It IPO'd a few years back, and I follow Berkshire Hathaway, the Warren Buffett company, closely. Warren Buffett and Berkshire Hathaway actually participated in Snowflake early on and owned some shares, and that turned my attention to Snowflake. Initially, the stock shot up dramatically. We had a little bit of a tech bust during that 2021 into 2021 into 2022 period, and Snowflake sold off like the rest of them. It has since recovered, and I had bought shares at various times. I'm up thousands of dollars, but on a percentage basis, my stock position hasn't been massive. I own hundreds of shares. That's why I'm up thousands of dollars. However, in the options market, I have done incredibly well. And so this is a good example where the stock has done good. The options have done great. And how is that possible? Well, let's back up a little bit and talk about Snowflake, the company, and then how you can utilize options to maybe improve a position like that. This is not a suggestion that you should rush out and buy Snowflake stock. It's purely an example that I've been able to utilize in the options market, and you can use other stocks and do your own research, be it Snowflake or any other company, and make sure that it's right for you. But Snowflake is basically a cloud-based platform. They operate in the technology space, and what they're designed to do is to store, to organize, to analyze large amounts of data, and then run that basically for other companies. So they're going to give you access and allow you to quickly store and share and securely do this without needing different servers or hardware to do that, so that you as a company can share that with other businesses. And so you're going to be able to, and it's pretty amazing what they can do. They can crunch the data and really analyze it to give you output that will make your own business more efficient, more effective, save you money on expenses, etc. So that's what they're designed to do. Now, in order to compete against other massive large tech companies, one of Snowflake's troubling aspects is that they have to continually issue stock shares. They have to entice those amazing employees to stay with the company, and in order to do that, they issue stock shares and other bonuses. Well, that's good and bad. A, they're keeping their talent, but B, it's costly. And every time they issue additional shares to those members of the firm, those employees, well, it dilutes us as shareholders. So I'm very aware of this. This is happening not just with Snowflake, but with many companies, of course, constantly. And so we need to understand that our shares are being diluted. That over time, there's more and more shares created. Now, one way that companies will offset that is they'll use some of the money that comes in through profits and other means to buy back shares. And that can kind of create sort of equilibrium where you don't continually get diluted, but they could be using that money elsewhere. And so that's always a concern when you're getting into a tech company that's a little newer. It doesn't have the footing that an Amazon does. It doesn't have the long-term footing that a Microsoft does, and yet it's competing with these types of businesses. How do they compete, and how do they grow to become the next Microsoft or the next Amazon? Obviously, they're going to have to innovate. They're going to have to go with the opportunities and see, kind of like Wayne Gretzky, skate to where the puck is going, see maybe where technology is evolving, and get there first or get there best. And so there are some concerns with a Snowflake, but we can utilize the options to create some income stream. And so I was looking at the options before I jumped on here, and an at the money option was going for about 5% of the stock's value. So a 5% at the money option, what does that tell us? Well, it tells us that A, the stock is fairly volatile. This is just over a 1-month option. And B, it tells us that there's a lot of premium in the options for us as option sellers to take advantage of different opportunities. And so looking at a 5% at the money option, if we were to sell that as a covered call, it would offset about 5% of downside. So if we sold that at the money call and the stock went down, even if the stock went down 4%, we'd still be up net. Our stock would lose 4, but we'd make 5% in the option. So we'd be up 1%. So it's a good hedge. It's a soft hedge. It's not truly protecting the downside, but it does create a buffer. And if you collect a 5% premium, it creates about a 5% downside buffer. If you collect a 3% premium, well, you've got about 3% of downside buffering so that you don't lose on that initial drop. So that's one way to think about options. The other is just that if we can continue to maintain the option or the stock position, but generate some conservative. We don't usually sell the at the money covered calls. We might sell an out of the money, but we pick up 1% here and 2% there. That adds up over time. And so what I've been able to do with my Snowflake position is even as the stock has fluctuated, and I'm not up a ton, I'm up nicely, but not up a ton on the overall stock, the options have reduced my cost basis so significantly that in a very short period of time, I'm going to have the position fully paid off, meaning that the income that has come in from the options will have paid me back all that I originally invested in the stock. And now what do I care what the stock does? I can continue to generate income, and that puts you in a position of strength. Now, if Snowflake were to go up dramatically, or any stock that I own, and I own hundreds of shares, well, now it becomes worth a car, and then it becomes worth a house, and then it becomes worth 5 houses, and then you get the idea. So if it were to be the next big thing, and that's always a big, big if. I'm certainly not suggesting that it has a high probability of that. It has a very low probability of being the next NVIDIA or the next Amazon, but there's still a probability there. And if it were, that stock position could grow massively in addition to the option premium. And that's one of the huge things that stocks give you, is that ability to capitalize massively on upside movement. So whether it's Snowflake or any other company you own, learn to utilize options both for protection, for soft hedges, for hard hedges where you just limit the downside risk. You need to know how to delta hedge, how to get beta weighted, how to get delta neutral, all of these things that we teach at the Cashflow Academy so that you can have less risk than others involved and yet capitalize on the big upside moves that some of your stocks can and probably will make into the future. Hope you enjoyed this video. Hit that subscribe button. Make sure you hit the notification bell to be notified about the next one. We'll see you in the next video.